The demand for crude oil in the US is given by Q equals 500 minus 10p. The domestic supply is Q equals 10p minus 100. The current world market price is $10. Calculate the change in total surplus value in moving from autarky or no trade to free trade. Because the free trade price is $10, we first need to calculate the domestic autarky or no trade price. We need to calculate the price at which demand is equal to supply. So if you set QD equals QS, you will have 500 minus 10p equals minus 100 plus 10p, which gives us 20p equals 600, so p equals 30. Here's the analysis. You notice the domestic price when there's no trade, p equals 30. And the quantity, if you plug 30 into the demand and supply equations, 10 times 30 is 300. Minus 100 is 200, so the quantity is 200. We're going to define the concepts of consumer surplus value and producer surplus value. Suppose you went to the store and you saw a product that you thought was worth $20. You went to the cash register with $20 in hand, intending to purchase the product if it costs $20 or less. You give the cashier the $20 and say, I'm willing to pay $20 for this product. She hands you $10 back along with the product. You got it for $10. You saved $10. That's a surplus value you got because you thought the product was worth $20. You paid $10 for it. So you got the product plus you got $10 back. So the surplus value is the difference between the price you're willing to pay and the price you actually pay. In this particular problem then, let's go back to the demand. And you see that there are consumers who are willing to pay a price of 50. Anything from a price of 50 down to a price of 30, there are consumers who are willing to pay that price. Everyone gets to pay the price of 30 when there is no trade. So all the consumers who purchased it for 30 but thought it was worth 31 or 32 up to 50 are getting some surplus value. Because we did the calculation and determined that 200 units were being sold at a price of 30, then every consumer who was included in that quantity purchasing the first 200 units would have gotten some surplus value, except for the last consumer who thought it was worth 30 and paid 30. We can calculate the area of surplus value to consumers, this triangle right here, and the height of the triangle is from 50 to 30, that's 20. The base is from 0 to 200, that's 200. So the height, half base times height, the height of 20 times the base of 200, half of that is 10 times 200 is 2,000. So we say the surplus value consumers got is 2,000. And there's surplus value to producers as well. The supply curve is really the marginal cost of production curve. And if you sell something for more than it costs you, then you are making some surplus value as a supplier. That is otherwise known as profit, but we'll just stick to producer surplus value here. So we're saying that the first producer supplying the first unit is willing to supply it if the price is higher than 10 because her cost is 10. If she can sell it for 30, then she's going to make a profit of 20. Suppose she continues to supply more and more at a rising marginal cost, but the 200th unit costs her 30, so she's breaking even on the 200th unit. We can calculate the area of profitability or producer surplus value. The triangle here labeled PSV0. The height is 20, the base is 200. So it's exactly analogous in area to the consumer surplus value, 2,000. When you get the sum of the consumer surplus value and the producer surplus value, we say this is the surplus value that the society got from producing 200 units of this product, 200 million barrels, in autarky, no trade. And we can do the calculation here. And you see that the consumer surplus value is 2,000. Let's set aside the dimensions for a moment, the millions and the dollars. So the consumer surplus value was 2,000. The producer surplus value was 2,000. So the total surplus value to both consumers and producers is 4,000. This is when there is no trade or when we are at autarky. We're going to move on to discuss the problem now when there is free trade. And we say at the current world market price of 10, consumers are getting more surplus value because they're paying a lower price. More consumers are also getting this surplus value. So the height of this larger triangle is going to be 50 minus 10 equals 40. The base is going to be 400. So we have 1/2 of 40 times 400, or 20 times 400, is 8,000. So we went from a consumer surplus value of 2,000 initially, right here, to a consumer surplus value of 8,000. So consumers are much better off. 4 times, if you did this straight calculation of 4 times 2,000 equals 8,000. The producers are going to have no surplus value. In fact, at a price of 10, no domestic supplier is willing to supply this product, and therefore there will be no profits because there's no domestic production. But when you aggregate the amount of surplus value consumers got when the price was 30 and the surplus value they get when the price is 10, we see that we've doubled the surplus value from 4,000 to 8,000. So even though the domestic producers had to shut down their operations, foreign suppliers were willing to supply all we wanted, and the gains to consumers exceeded the losses to domestic producers who had to shut down. So we see that the surplus value has increased. We would say then that trade is good because it increases the amount of social welfare value society gets. Beyond this particular industry, because we're importing now 400 million barrels of oil, the lower price that we have allows us to save money. We can take that money, invest it in the export sector, and we should be able to get some surplus value, because if we are importing, we may need to export. So there's 2 sets of gains here. We're saying we're gaining from a lower price, purchasing this product from foreigners, and we're also going to sell them something, and we'll get the surplus value. The fact they're willing to buy that thing from us means that we are supplying it for a lower price than they would, in which case their consumers are getting surplus value as well, and our producers are getting higher profits because that extra demand from abroad will push the price up. Higher demand, higher price, and therefore our domestic producers will be making more profit in that second sector, which is not shown here. But if you take the idea a coin has 2 sides, if we are importing, we need to be exporting in a world of balanced trade. And you could see that when we get a benefit here from the lower prices, we should also get a second benefit from the higher prices in our export sector, because there's something we can supply to the rest of the world. The calculations then that we do are change in consumer surplus value. So if we are in the 3rd column here, the change in consumer surplus value is a positive 6,000. The change in the producer surplus value is a negative 2,000, and the net 6,000 minus 2,000 is 4,000, and you could see that as we went from a surplus value of 4,000 to 8,000, the change in the total surplus value is positive 4,000. That is our conclusion, that trade is good, just in a partial equilibrium analysis. In terms of visualizing this increase in surplus value, we saw that the old surplus value, TSV0, was the triangle defined by the demand and the supply curve and the vertical axis. And now the total surplus value is the consumer surplus value between 10 and 50 on the price axis, and 0 and 400 on the quantity axis. So the triangle, which is below the demand and supply curves, which I label as change in TSV, that is the gain from trade, that larger triangle right there. And that area would be the 4,000 gain.